Simulations bring financial statements to life, giving you the ability to run experiments and immediately see the impact of your pro formas. Let's start with a balance sheet. A balance sheet answers the question, who owns what? On the left side, you have what's owned. It's all stuff. On the right side, you have a list of people who put up the money to buy the stuff. Suppose our banker puts in another $5 million. Current borrowing will increase from $10 million to $15 million. Cash will increase from around $792,000 to something over $5 million. Not exactly $5,792,000, however, because we will eat some interest expense. That will be reflected in a reduced retained earnings. Exactly how much? Let's run an experiment and find out. Bring up finance. Add $5 million to current debt. Our workbook tells us that adding $5 million in current debt would bring our cash account to $5,438,000, but our retained earnings would fall to $31,035,000. Once in a while, I'll get a question like, our company wants to buy more plant and equipment. How can we take money out of our retained earnings account to buy more capacity? Answer: you can't. Retained earnings is the portion of net income kept by the company instead of distributing it back to shareholders as dividends. I associate retained earnings with the chairman of the board. After all, it's the board that decides how much of the profits to keep in the company. There's a general principle in accounting called historical cost, which says that assets are valued at the amount shown on the receipt, on the grounds that a receipt is objective and verifiable. Suppose that 10 years ago the company bought a building for $5 million. Today we think it could sell for $9 or $10 million. What does the balance sheet show? Answer: $5 million. It's the only number we can agree on because we have a receipt for it. If we actually do sell our building for $10 million someday, we would capture the gain for the sale on our income statement. Here's a related question. Where do intangible assets show up? Things like designs of your products, your awareness, accessibility, customer lists, patents, etc. Where are they on the balance sheet and what are they worth? We only put things on a balance sheet that we paid for with cash. Therefore, if we cannot associate some hard receipts with these intangibles, their balance sheet value is zero. When and if the company sells an intangible asset like a patent, we recognize it at the time of the sale on the income statement. What about inventory? Inventory is valued at what it cost us. Of course, we hope to sell it for more than we spent, but that is not guaranteed. As we put sensors into inventory, the cost to us can vary because of R&D projects. In the simulation, we average the cost. In the real world, inventory valuations vary by industry, and it involves negotiations with vendors, the government, competitors, or even just what the rules should be. Okay, let's turn to the income statement. The general form of an income statement begins with revenue. In our case, we are selling inventory, and we simply call it sales. This brings us to another basic principle of accounting called revenue recognition. We do not recognize revenue against inventory until we make the sale. Do we recognize the sale when we get the order, when we ship it, or when we're paid? The answer depends upon the practices in the industry. Next come the costs directly associated with the inventory. In our case, material, labor, and inventory carrying costs. This is in keeping with a basic principle of accounting called the matching principle. It says that whenever we recognize the sale, we also recognize the costs directly associated with the sale. In our case, when we sell a unit of inventory, we immediately recognize its material, labor, and carrying costs. We can also refer to these costs as variable costs. What's variable about them? Just one thing. How many units did we sell? There are some expenses that are independent of our sales. We call them fixed costs or period costs. In our case, if we decide to spend $1 million on a promotion budget, it does not matter how many units we sell, we're going to write a check for $1 million. Even if we only sell one unit, we are writing that check for $1 million. Variable costs like direct labor are different from fixed costs because they vary with how much you sell. If you sell one unit, your labor costs might be $15 and your material costs $10. But if you sell 1 million of them, your labor costs are $15 million, and your material costs are $10 million. Contribution margin is simply sales minus the variable costs. It is important because from our contribution margin, we have to pay for everything else. In more dramatic terms, we have big problems if our contribution margin is less than our total period costs. Even then, our net margin must cover any miscellaneous other costs and interest payments. We can sharpen this up by asking the question, how many units do we need to sell to cover our fixed costs? In other words, to reach break even. EBIT stands for earnings before interest and taxes, which is another way of looking at the question. Who gets the wealth that was created? The candidates are debt holders, the government, employees, and management. Earnings, wealth that management worked hard to create before we had to give some of that wealth to bankers as interest and to politicians as taxes. Observe that employees and management get whatever's left. From a certain point of view, an income statement is a highly evolved document, the net result of arguments between the stakeholders over the question, who gets the wealth that is created? The stakeholders include bankers, government, stockholders, management, and employees. Consider depreciation. Depreciation recognizes wear and tear on equipment. But it's easy to imagine an accounting system where depreciation did not exist. Do you ever write a check for depreciation? No. So why would government allow us to pretend that we did? Well, after much debate, government decided it was in its best interest to have the company thrive. Depreciation guarantees cash flow back into the company for reinvestment. Government cares because it gets far more out of the company than any other stakeholder. How much money did the government get out of this income statement? $86,000? Depending on your company's location, government might take payroll taxes, sales taxes, or value-added taxes. In the U.S., of the 42.8 million in direct labor, roughly 12 million would have been sent to the Internal Revenue Service, far more than the 86,000 in corporate income tax. Even if this company had lost money, the government would still have gotten its $12 million in payroll taxes. In short, an income statement does more than track transactions to determine how much wealth was created. One of its primary purposes is to satisfy our external stakeholders, particularly government, that we are being honest. Let's continue on to the cash flow statement. This statement shines a spotlight on the cash account. The cash flow statement displays inflows and outflows through the business. It reports the change in account position from one year to the next. The cash flow statement is broken into three parts: operating activities, investing activities, and financing activities. Let's start with operating activities. First, we see net income. Put another way, all that happened on the income statement. All the checks that we wrote during the year for R&D, cost of goods, promotion, warehousing, interest payments, taxes, etc. All of it has been simplified to the question, when the dust settled, what was the net result? Most of the line items here in the cash flow statement are similar. When the dust settled, did our inventory go up or down? If inventory went up, it sucked down the cash. If inventory went down, it added to cash. Money flowing into the cash accounts shows up as a black positive number. Money flowing out of the cash accounts shows up as a red negative number. At a glance, we can see that inventory shrank by 3 million, and as it shrank, it added 3 million to cash. We are looking at the net change. The net change in accounts payable was negative 200,000. The net change in accounts receivable, negative 2.1 million. To an outsider, a cash flow statement is hugely helpful because it simplifies all the activities. A banker might think, inventory shrank by 3 million. Maybe I should take a closer look. Or a vendor might say, their change in accounts payable is small. Good, they must be paying their bills. However, depreciation deserves special mention. Remember that depreciation appeared on the income statement. From the income statement's point of view, it's like we wrote a check for depreciation. But of course we didn't. And because we didn't, the money is still sitting in the cash account. It is a guaranteed flow into cash. One last observation about operating activities. Generally speaking, we would not expect enormous fluctuations in accounts payable, inventory, or accounts receivable from one year to the next. We would expect the net change in them to be close to zero. Likewise, we would not normally expect extraordinary gains, losses, or write-offs, as they usually have something to do with selling a big asset like plant and equipment. Therefore, if all of these are usually close to zero, then the bulk of net cash from operations should be net income and depreciation. If that is not the case, then it's worth investigating. Next, we come to investing activities. There's only one investing activity available in our world: plant improvements. And as you know by now, our plant improvements can be considerable. $20 to $40 million investments are not uncommon, far more than we can usually cover out of operations. Therefore, whenever you see a plant improvement, you should immediately ask the question, how did the company fund it? One funding source is depreciation. After all, that's why depreciation exists, to fund plant improvements. But for the rest of the funding, we have to turn to the third category: financing activities. It addresses all transactions that can occur on the right side of the balance sheet. We might get more cash from our stakeholders, or we might give money to them. Plant improvement is a long-term investment, and therefore we want to fund it with long-term money, some mix of stocks or bonds. It's a bad idea to fund a plant with short-term money like current debt. Current debt should fund things like expansions in inventory or accounts receivable. Outside stakeholders are keenly interested in financial activities. Stockholders are interested in dividends, stock issues, and stock repurchases. Bondholders want to know about bonds issued or retired. Our banker is interested in whether our current debt has gone up or down. Finally, when we add up cash flows from operations, investing, and financial actions, we have a net change in cash position. In this particular example, we started the year with no cash. It increased $792,000 and therefore ended the year with $792,000. Accounting is not really about the tedious tracking of transactions. Accounting exists to avoid or settle arguments. We have a balance sheet. It tells us what is owned and how much stakeholders coughed up to pay for it. We have an income statement. It clarifies how much wealth we are creating and which stakeholders get the wealth. We have a cash flow statement. It focuses on choke points in the financials. The cash account. By keeping an eye on the money flowing through cash, we get an insight into the operations of the company. Good luck!